We're going to finish chapter 3 today. Also, I'll point out, if I can get this to show up, that you're going to have your first quiz opening this week. That may not open until Wednesday or possibly Thursday, but it's going to cover chapter 3. There will probably be 10 questions on the quiz, all multiple choice. And what it does, it'll pull from probably a bank of about probably 30 questions. So depending on, now they're not all calculations, some are, and again, they're the ratios. So some of you may get more calculations than others. I can't help that. That's just sort of how it works. But again, this is just to get you to look at the material before the test. So if you go to your course homepage, work your way down here, you will see quiz 1. This is actually not the correct quiz, but there will be another one here. So there will actually be 5 quizzes showing, okay? So quiz 1, and it'll probably open tomorrow or Thursday, and it'll stay open for probably about 3 days, just to make sure everybody has plenty of time to take the quiz. You'll be able to take the quiz 3 separate times. Your highest grade counts, okay? Now, it's going to show up as 100 points, okay? But keep in mind, quizzes only count, what percentage was it? 6% maybe? Whatever it says in your syllabus. So even though it says 100 points, it's a small percentage of your grade. So, and sometimes this throws people off. I'm going to try to actually get this worked out. But when you go to your grades, you're going to see, for example, after test 1, you'll see your test grade. You'll see a quiz grade. And it's going to give you your average on Canvas. The problem that I've run into is I haven't figured out how to weight the grades accordingly. So what that means is a test shows up counting the same as a quiz. And that's not true, because a test counts 20-something% of your grade. A quiz only counts maybe 5 or 6% of your grade. So I'm going to work on that, but the reason I'm telling you this is a lot of times at the end of the semester, and I will tell you this, if I can't get it fixed, I will tell you this 10 times during the semester. And I will still have people contact me after grades come out, and they will say, Dr. Lacewell, on Canvas, it said that I had hundreds on all my quizzes, so that's going to pull your grade up artificially high. I had a 92 on Canvas, but I made a B in the class. How did that happen? And then I have to go back and to explain, well, do you remember the 10 times that I talked about your grades not being weighted accordingly? And so I have to go through that. So I'm just trying to, this is the first time you're going to hear it. You're going to hear it several more times. If you're listening now, next time I talk about it, you can just shut down, okay? You can tune me out completely. But I'm going to try to get that solved so nobody has to ask me that question. And if I do, I will jump up and down with joy and let you know that it is fixed. All right, let's see. What else? Under employment information, you'll get an email probably later today from me, or maybe tomorrow. And actually there's something here. The Office of the Comptroller of the Currency, the OCC, they are hiring again. They have certain application windows, typically 2 per year. And so they've got an application window open now. It's going to stay open until, I think, February 17th. This is a bank examination agency. They're looking for business majors, so you don't have to be a finance major. But if you happen to be graduating in the spring or the summer, you may want to look into this. This is where I started my career, so if you have questions about it, I'll be happy to talk to you about it. It's a fantastic place to work. I've got several students who are working there now, and I think every one of them has good things to say about it. So again, that's if you are graduating in May or in the summer. All right. Now, let's jump into chapter 3. I think this is where we left off. Actually, I think I have it set so that my Bamboo is actually working now. So let's see here. Oh, it is, okay. So I can draw faces now. I can draw, what do you want a person? I can draw a person. I can draw a car. Draw a car. I mean, do you see why I wasn't an art major, okay? Do you see why I decided to go with finance instead? But again, this makes it a lot easier. The only thing I will warn you about is when I'm up here writing on this, a lot of times I'm looking at this screen and I'm having to write here. So sometimes it doesn't come out really well. My handwriting's bad enough as it is, and now they're asking me to look one place and write somewhere else. But we should be able to hopefully work our way through that. All right, so let's pull up. Okay, ratio analysis. So we left off talking about, well, we're at debt ratios. So we've been through a couple of different types of ratios. We're on the third different set of ratios. And again, now keep in mind, debt is borrowed money. So when a company borrows money from a bank, that is debt. When a company issues bonds, and we're going to talk about bonds more in chapter 6, that is debt. That means that is a legal obligation that they have to pay back. And I've got a statement here that says the greater the debt level, the greater the financial leverage. And then I've got a comment here, got a question that says, what is financial leverage? So could somebody tell me, and it doesn't have to be a perfect textbook definition, but what's financial leverage? All right, so let's simplify it. So what is leverage? Not financial leverage, just leverage. What's the definition of leverage? Right here. The what? Advantage you have, okay. Okay, so positive effect, okay. Anybody else want to add to that? Okay, now, you might be sitting there kind of picturing leverage in action, but maybe you don't know how to put it into words because it's not that easy to define. I would say, and again, I'm just making this definition up, but if I think of leverage, I'm thinking of using less force than would otherwise be required to maybe move an object or lift an object or magnify your ability to move an object. So I'm thinking of, let's say there's a big boulder in front of the door and you're wanting to leave. And so, you go up there and you push on that boulder and you can't move it. But you just happen to have a long steel pole sitting here. And you've got a smaller rock. And so you can take that pole, you can jam it under the big boulder, you can put the smaller rock under it, and you can push down on the pole, utilize leverage to roll the boulder out of the way. Okay? Now, that's sort of what I think of when I think about leverage. Financial leverage is similar to this, but let me give you a definition of financial leverage. Financial leverage is utilizing borrowed money to magnify your gains or losses. Utilizing borrowed money to magnify your gains or losses. Okay, so what does that mean? Utilizing borrowed money to magnify your gains or losses. Let me show you a sample of leverage. Let's say, for example, see, let me come up with some numbers here. Okay, let's say, for example, that you want to buy some stock, okay? So you do some research, you find a stock that you want to purchase, you purchase that stock, and you're using all of your money. So you purchase, you just happen to have, I'll just use some nice round numbers here, you just happen to have $10,000 worth of stock that you buy. You wait a year, so we're going to make this precise because it's my example. You wait 1 year exactly, you sell the stock 1 year later, and you sell it for $12,000. So you have made a profit of $2,000. Now, if we're going to calculate the percentage return, the formula for calculating a percentage return is simply, and this is just a nice formula for anybody to know, it's the new price minus the old price divided by the old price. And this is just a percentage return formula. So you can use this anywhere, okay? You're out shopping and something that says it's, it goes down from $10 to $8, you can calculate what's the percentage off of that, okay? In this case, we can calculate a percentage gain. So if we take the new price, which is $12,000, minus the old price of $10,000, divided by the old price of $10,000, that equals 0.20 or a positive 20% return, which is really good. I mean, that's a fantastic return for a 1 year investment. So you're pretty happy. But let's say, for example, so we've got this. Now remember, this was all your own money. Now let me move some of this out of the way. And let's say, for example, now we've got the same start to our problem. You want to buy $10,000 worth of stock, but you're going to put in $5,000 of your own money. You're going to borrow $5,000. So now you're using debt to help you purchase the stock. Well, in this case, let's say a year later the stock goes up to $12,000. You sell it. You made a profit of $2,000. Everything's the same. The only difference is you have borrowed $5,000. So in this case, if we're calculating the return on your investment, the money that you put at risk, it's going to be the $2,000 profit divided by what you invested, $5,000. So in this case, the return on your money is now 0.40 or a positive 40% return, because you're using somebody else's money to help magnify, in this case, your gain. So does that make sense, kind of how that works? Now, you need to keep in mind that, this looks really good. So you may be looking at this going, wow, that makes a lot of sense, and that's pretty smart. So if I invest, I should use other people's money. And again, there's nothing wrong with that, but you have to keep in mind that financial leverage works both ways. It works if you make money, but also if you lose money, it magnifies your losses. So you have to keep that in mind, and you can lose a lot of money quickly in the stock market. When we get to chapter 7, we'll talk about how to buy and sell stock. We will talk about borrowing money from your broker. There are accounts you can set up where you can do that, but I'll also give you some warnings on you need to be really careful if you're doing that. All right, so this is financial leverage. Just a really quick little primer there. Okay, so we've got three ratios here: debt ratio, times interest earned, and fixed coverage ratio. All right, now again, keep in mind we're using table 3.1 and 3.2, which are on pages 63 and 65 maybe. Is that right? Okay, the income statement's on page 62, and the balance sheet's on page 65. Now again, I'm going to need your help with this as we go through and calculate these various ratios. So it says the debt ratio is equal to total liabilities divided by total assets. So now the problem with this is whenever I bring up my screen here to write on, I can't get it to where it splits into different screens, so it kind of disappears. So somebody remind me, now again, if we're looking at our formula, liabilities divided by assets. So for our company for 2015, what are total liabilities? Okay, so we've got our debt ratio. Okay, total liabilities are how much? 1643 divided by, it's supposed to be a 4, 1643. Divided by total assets, we've used that number several times. That is 3597. Okay, so 1643 divided by 3597 equals how much? How much? 45.7. So it's probably going to look like this, 0.457. Okay, so 0.45768, so we'll say that. Or 45.77%. Or, and I'll just round up, I'll say 46 cents per $1 of assets. Okay, so this is an important ratio because this tells us of the total assets of the corporation, how much has this company borrowed to fund those assets. And this particular company has borrowed 46% of its assets, or 46 cents for every dollar of assets. Now, if we go back to and take a look at the formula, it says this measures the proportion of total assets financed by the firm's creditors. A creditor is somebody who loans you money, and the higher the ratio, the more financial leverage is utilized. So again, the higher this number, the more financial leverage, or the more a company would benefit if they make money, or they're going to definitely, if they lose money, they're going to suffer from that. Now, is 46 cents per dollar of assets, is that high or low? Well, we really don't know. And that's another one that's going to vary a lot among industries. Some industries can handle a lot of debt. It's just like some people. You probably know people who they have borrowed money for everything that they've purchased. And they are up to their eyeballs in debt. But it doesn't seem to bother them. They just keep going. Other people are not comfortable with any debt, or maybe just a very small amount of debt. They just don't like having debt. So again, just like people are different and people can handle different types of debt and different amounts of debt, corporations are the same. But the debt ratio, and we'll come back and take a look at that a little bit later. Okay, the next one, the times interest earned ratio. Now again, keep in mind what this consists of. This consists of EBIT. Now this stands for earnings before interest and taxes. EBIT. If you look at your income statement, you're not going to see the letters EBIT. It's called something different. What's it called on your income statement for 2015? That's exactly right, operating profit. Okay, so if you go down your income statement, right above taxes, right above interest expense, it's going to say operating profit. So that is what the company makes, earnings before we take out interest expense and before we take out income taxes. So this company's operating profit for 2015 is 418. So if we take our EBIT of 418 divided by interest expense, which we've talked about that before. The interest expense for this company for 2015 is 93. So let's be 418, okay? Divided by 93 equals how much? How much? 4.49. So 4.49 times. So what this tells us is this company, in terms of earnings before interest and taxes or operating profit, it makes 4.49 times as much as its mandatory interest payments. Because again, remember, interest payments, they're not negotiable. You have to make those interest payments when they come due. Interest is what you're paying to use somebody else's money. So basically what this tells us is this gives us an idea of how much cushion we have in terms of making that $93,000 worth of mandatory interest payments. We make $418,000 in operating profits. So we've got a cushion of 4.49 times. Is that good or bad? It's probably pretty decent. But again, it's going to depend on the industry and the company itself. Now, what this means is the higher this ratio, the more cushion a company has. Now, this is similar to possibly what you may be going through right now. Because when you're in college, a lot of times, if you were like I was when I was in college, you don't have just a lot of money. And so you have certain monthly expenses. Let's say, for example, that you have, I'm just making this number up, let's say you have $1,000 in monthly expenses. And your income, your take-home pay, just happens to be $1,000. So right now, your ratio is 1.0. So you've got mandatory payments of $1,000. You've got income of $1,000. So that's the same thing that we're seeing up here, okay? Same concept. But what you hope is going to happen is once you graduate, you're going to get a good job. Your pay is going to increase, hopefully increase a lot. And so let's say, for example, that you get a job. Your pay is now $4,000 per month. Your expenses, and let's say you're fairly, you don't spend a lot of money. You're still fairly conservative with your spending. You have $2,000 worth of expenses. So now you have a ratio of 2 to 1. What this means is if something goes wrong here, your car breaks down, you've got an unexpected medical bill, something like that, you don't have any cushion to make those payments, to meet those emergencies. But with this example, if something happens, you do have some cushion that you can, if something goes wrong, you're going to be able to make those payments, hopefully. Well, that's the same thing here. With these interest payments, which are $93,000, this company has to make those interest payments. So again, the times interest earned ratio, think of the name, times interest earned, it simply gives us an idea of how much cushion the company has when it comes to the mandatory interest payments. All right, and so that's what this says here. Measures the firm's ability to meet contractual interest payments, and the higher, the better. All right. Now, this next one, we're not going to calculate this, okay? And when you look at it, you'll probably thank me for that. But I will at least tell you what it is. This is what's called the fixed charge coverage ratio. The last one talked about how much cushion did we have when it came to making interest payments. This one, it tells us here, Measures the firm's ability to meet all fixed payment obligations, and typically the higher the better. But keep in mind this statement here, you do not have to calculate this for the test. And the reason is there's a lot of information here that typically is not found on an average income statement or balance sheet. All right, so fixed charge coverage ratio. All right, now let's talk about profitability ratios for just a minute. These are really, really popular ratios. Everybody looks at these. Investors look at these. Analysts look at these. Management takes a really close look at this. Stockholders, et cetera. And we've got some of these are listed. I don't know if all of these are in your book or not, but we've got profit margin ratios, gross profit margin, operating profit margin, and net. And then we've got ROA and ROE. So these, again, these are all fairly common ratios. The first one is gross profit margin. It's equal to gross profit divided by sales. So for our company for 2015, the gross profit is how much? That's found on the income statement. It's going to be the third line down, and it's how much? $986 divided by sales of how much? 3,074. Okay, so 986 divided by 3,074 equals what? How much? 0.32. Okay, so 0.32 or 32% or 32 cents per $1 of sales. So this particular company, whenever it sells $1 worth of its product, it makes a gross profit of 32 cents. Again, good or bad, we really don't know at this point. But, you know, for some industries that might be fantastic. For others, it might not be so good. All right, the next one, operating profit margin, equals operating profit divided by sales. So if we go back to our income statement, we just looked at operating profits earlier. We said that was 418. And I'll go back to the same one here. Okay, so operating profit margin, so that's 418 divided by sales of 3,074. And so that equals how much? 0.14. Okay, so 0.14. So 0.14 or 14% or 14 cents per $1 of sales. Now we said operating profit, that's after the company has paid for its cost of goods sold and it's paid for its operating expenses. This company makes 14 cents. Again, good or bad, we don't really know at this point. And then the last profit margin ratio is net profit margin. And it's equal to earnings available for common stockholders divided by sales. So for this company, I'll give you a second to get that written down. Now, this company, we said, does have shares of preferred stock, so earnings available to common stockholders are going to be different than net profit. If it doesn't have preferred stock, then it's simply going to be net profit divided by sales. We're going to jump down to earnings available to common stockholders. And so for our company here, the net profit margin, earnings available to common stockholders are 221. Divided by sales of 3,074. So this equals how much? 0.07. Okay, so 0.07 or 7%, or 7 cents per $1 of sales. So when this company sells $1's worth of stuff, whatever it is, it makes a profit, a net profit of 7 cents. Now, good or bad, we really don't know. In some industries, that would be terrible. In other industries, that may be a pretty good net profit margin. So we don't really know. I mean, if you're looking at something like, let's see. Oh, okay. Valentine's Day is coming up. Some of you may be buying jewelry for your special someone. Jewelry has a really, really, really high markup. Okay? I'm talking about good jewelry, but it has a really high markup. 200, 300, 400% sometimes. That's why jewelry, if you look at jewelry stores sometimes, they're constantly having 75% off sale, 80% off. Well, how can you have an 80% off sale all the time? The reason is you mark up your merchandise so much initially. So what I'm telling you is when it comes to buying jewelry, you have some negotiating power. And they will deal with you. I mean, you say, look, this, I'm shopping around. I need your best price. I mean, they will start going down on the price. Okay, so just for those of you who are shopping around for jewelry, there you go. I saved you some money. All right. You believe me, don't you? Telling the truth. I bought lots of jewelry in my lifetime. Okay, so I know. All right. So net profit margin. Now, a couple of other ratios that are really, really popular. One is ROA, return on assets, or this is return on total assets. And it's equal to earnings available to common stockholders divided by total assets. It says here at the bottom, this measures the effectiveness of management in generating profits with its available assets. Generally, the higher, the better. Okay, so what that tells us is, and what that means, is for this company, we're going to look at the earnings available to common stockholders, which we just calculated as 221 divided by total assets. So, ROA. 221 divided by total assets of 3597. So for this company, its ROA equals how much? 0.06? 0.06. So 0.06 or 6%. Okay, so 0.06 or 6% return on assets. Now, let me point out something. Sometimes you're going to see this listed like this. This stands for return on average assets. So maybe if you're in an accounting class or if you're working for a certain company, sometimes they're going to calculate the return on average assets and not total assets, and that's probably actually a little more accurate. But for purposes of in here, we're just going to go with ROA. Now, if you look at a 6% ROA, you may think, wow, that's low. Let me ask you this question. For the average bank, a lot of times people think that banks make just a lot of money. But for the average bank, what would you say would be a good return on assets for a bank? 6%, 10%, 2%, 20%, 1%. So your bank, most of you have bank accounts. What would you say a good ROA would be for a bank? Any guesses? Any estimates? 5. Okay, good. 3. Okay, what else? What? 1. Okay. If you are a banker, if you're a bank president and you run your bank, if you can average an ROA of 1%, you're going to have a job forever. And that seems like a really, really small ROA. And it is. Return on assets, 1%. That means if you have a bank that has $1 million in assets, if you make a profit of $1 million, you're doing well. But again, 1%, that's a tiny amount. Now, if you look at this, this is one reason. A lot of times when banks, people sometimes give banks a bad name because they say, well, banks only lend to people who really don't need to borrow the money. Maybe people who are financially secure, or a bank doesn't want to take a risk on me and make me a loan. Well, the reason is, this is one of the reasons a bank has an ROA of 1%. It can't afford to make very many bad loans. Just a few bad loans is going to eat up this 1% ROA. It's gone. And then if a bank has something called an allowance for loan and lease loss, that's set aside for bad loans. When that's zeroed out, then money comes out of profit. When this is zeroed out, then money comes out of capital. And once your capital goes down to a certain level, that's when the examiners, which the OCC is one of them that I talked about earlier, that's when they come in and simply shut down your bank. It's closing. And since the financial crisis of 2008, we have had over 500 banks close just in the United States since 2008. Over 500 banks. So ROA, pretty popular. It's going to vary a lot among industries. And the next one is ROE, return on equity or return on common equity. This is earnings available for common stockholders divided by common stock equity. Okay, so for this ratio, ROE, earnings available to common stockholders, which we just looked at, which we said was 221, divided by common stockholders' equity. So we've got to make a slight adjustment here, because if you take a look at your balance sheet, you're going to see at the bottom, it's going to say total stockholders' equity of 1954. But further up the balance sheet, it's going to say preferred stock 200 or 200,000. So in this case, this is just the return on common stock equity. So we need to subtract from that the 200 of preferred stock equity. So that's going to leave us with 221 divided by 1754. And so that equals how much? How much? 0.13. Okay, so 0.13 or 13%. Okay, so this company has an ROE of 13%. Now, a lot of times, people, when they look at this, they think, oh, well, that if you invest in this company's stock, that must mean that's what you earn, okay? And that's not actually the case. That's not what you earn. So if we go back and take a look at the ratio, it tells us, it says this measures the return on the owner's investment in the firm. It's closely monitored by investors, but it does not represent an individual stockholder's actual return. It's just how much is the company making on the stockholder's equity portion that they have provided. So, ROE. And then the final group of ratios, again, these are looked at really closely. Earnings per share, the PE ratio, and the market to book ratio. So as we take a look at these, as we look at the first one, earnings per share, this is equal to earnings available for common stockholders divided by the number of common shares outstanding. So the EPS. Now, this actually gives you the EPS. It tells you this at the bottom of the income statement. But we might as well go ahead and calculate this. So earnings available to common stockholders divided by the number of common shares outstanding. So let's go here. Let's type in EPS, put in here EPS. So the earnings available for common stockholders, which we've used several times now, is 221 divided by the number of common shares outstanding. So for this company, for 2015, how many shares of common stock does it have outstanding? If you look at, if you go to your balance sheet, look at common stock. It says 250 par. Okay, so it says in 2015 it has issued and outstanding 76,262 shares. Okay, so that has to be given to you. Now, what I'm going to do, this is actually a decimal. And the reason that I did that is, remember, all of these numbers are in thousands. So this is actually 221,000. Now, I had a couple of options here. One is I could divide the 76,262 by 1,000 to put everything on the same playing field, and it's going to be 72.262. Or the other option is I could have written this as 221,000 divided by 76,262. Doesn't really matter. It'll come out the same way. And it should come out to, if your book is correct, $2.90 per share. So is that correct? 290? Okay. So again, this is just another way of stating how profitable the company is. This company made $2.90 per share of common stock outstanding. Again, good or bad, we don't really know at this point. We could have said the company made $221,000, or we could say it made $2.90 per share. Okay. The next ratio, the price-earnings ratio, or sometimes we refer to it as simply the PE ratio. It's equal to the market price per share divided by the earnings per share. So for our company, okay, we have to have, first of all, the market price per share. That has to be given to you, okay? So if we look in the book, if you look in the reading further back in the chapter, you're going to find that this stock is currently selling for $32.25 per share. So if we want to put the PE ratio here, so it's going to be the price per share, which we just calculated, is $2.90, okay, that was there, divided by, and this has to be given to you, $32.25, the market price. So this is what the stock is selling for on the stock market right now, $32.25 per share. I'm sorry. Let's change this. That, there, this, there. Okay, so it'll be $32.25 divided by $2.90. All right, so this equals, according to your book, 11.12. Or another way of saying this is $11.12 per $1 of the past year's earnings. Okay, so let's talk about this ratio for a minute. This is a really, really useful ratio. Now again, take a look at what it's telling you. The stock is selling for $32.25 per share. So if you pay $32.25 per share today for this stock, and this company made $2.90 last year, essentially you're paying $11.12 for $1 of company earnings. Now again, that you're paying $11.12 for $1 of earnings. Is that good or bad? Well, we don't really know at this point, but the PE ratio is a measure of how expensive a stock is. And the reason that this is useful for us is because you can't just look at a stock and look at the price it's selling for and know, is this an expensive stock or is it an inexpensive? I don't like to use the word cheap for stocks, but an inexpensive stock. The reason being that right now, you can look at the stock market and we can find stocks that are selling for $1,000 per share. We can find stocks that are selling for $100 per share. We can find stocks that are selling for $10 per share. We can find stocks selling for $1 per share. You can find stocks selling for 10 cents per share, or even 2 cents per share. The problem is we just can't look at that stock and know, well, is that a good price? Is that an expensive price, or is it not an expensive price? Now, with some goods, you know whether they're expensive or not right away. For example, if I walk into a store, let's say I walk into a clothing store, and there's a table of socks at the front door. And there's a sign on the table that says socks, $100 per pair. Automatically, I know those are some damn expensive socks, okay, $100 per pair. But if I look at a share of stock and it says it's $100, I really don't know if that's expensive or not. But if I take the earnings of this stock, which in this case is $2.09 per share, and I take the market price, and I work through this, I'm finding that I'm paying $11.12 per $1 past earnings. Now, this really depends on the market and what's happening, but typically, if the PE ratio is less than or equal to 15, normally that would be considered an inexpensive stock. That means you're paying $15 or less for $1 of company earnings. And if the PE ratio is greater than 15, that would be an expensive stock. Now again, these change, okay? It changes with the stock market, it changes with stock prices. But again, it gives us some idea of not only how expensive the stock is, but also how excited are investors about the future of this company. So what typically happens is, as investors get more excited, you see the PE ratio increasing. It goes up. So if you look at a company like Under Armour, okay, I pick on Under Armour a lot because I actually follow Under Armour because I've been watching it for about 2 years now, 2.5 years, waiting for a significant drop in the price because it's been really expensive. It's been selling for PE ratios of 80. That means you're paying $80 for $1 of company earnings, and that's just really expensive. In PE ratios of 60 and then 50 and 40. Now, the price of Under Armour stock has been hit really, really hard lately because of a lack of profitability and a lack of growth. Now, they're still growing and they're still making money. It's just they're growing slower than they have in the past and they're making less money than they have in the past. So now, Under Armour is down to a PE ratio of around 25. And so that's getting into a pretty good area where it might be a good purchase because it's come down because investors are not quite as excited about the future of Under Armour. But it's not uncommon to see some stocks selling for a PE ratio of 300. That means investors are paying $300 for $1 of company earnings. That is crazy. And whenever you see a stock market collapse or a stock market bubble burst, that's one reason that it will eventually burst is because investors get really excited. They start investing in stocks they know nothing about. The reason is everybody that they talk to is making money in the stock market. So the market's going up, everybody's happy. You know, your parents are making money, your sister's making money, your friends are making money. So you just start throwing money at stocks. You don't look at things like the PE ratio. And you start buying stocks with PE ratios of, 60 or 200 or 400 even. Now, what that means is eventually investors are going to look at this and they're going to say a PE ratio of 400, that is crazy. I need to sell this before something happens. And so guess who gets burned when a stock market collapses? It's normally the small investor who gets in last. They paid the highest price for the stock, and then when the stock market collapses, they're the ones who are left holding the stock. Okay? So again, when you get away from investing fundamentals, a lot of times you can really get hurt. All right, so that is the PE ratio. Again, a really, really good ratio, and there's a couple of comments about that down here. Okay, now the next ratio, the market to book ratio. This is equal to the market price per share divided by the book value per share. Now, for the book value, sometimes you're given the book value, sometimes you have to calculate it. In this one, this example, we'll just go ahead and calculate it. So I'll give you a second to get this written down, and then we'll jump into calculating the book value per share, and then we will use that to calculate the market to book ratio. Okay, so for this stock, the book value per share is equal to the, okay, so this is the book value. It's equal to the common stock equity, which we said earlier was the 1954 minus the preferred stock equity, divided by the number of shares outstanding, which we said was 76,262. So we're going to change that again to 76.262. And so if you work through that, you're probably going to come up with a book value per share of $23. Now, what this means is that on the balance sheet, this company is worth $23 per share. Common stock equity divided by the number of shares outstanding. It should sell for $23. So if something happened to this company and we sold off all of its assets, we paid off all of its debts, we should be able to get $23 per share for this company. Now, the PE ratio, the market to book ratio is going to be equal to the market price per share, which we said earlier. Again, this has to be given to you, $32.25, divided by the book value, which we just calculated at 23. And so, according to your book, this equals 1.4 times, or $1.40 per $1 of book value. So what this tells us is if we pay $32.25 on the stock market for this stock, we're paying 1.4 times the book value of this stock. Again, it doesn't necessarily mean it's good or bad, but what you have to watch for is typically the higher this ratio, again, the more confidence investors have in the future of this company. When this starts getting down close to 1, for example, let's say that it was selling for 23 and the book value is 23. So now you're at 1. Or let's say that it's selling for 20 and the book value is 23. Well, I don't know what you're at, but you're at less than 1. What this means is, and we talked about this way back in chapter 1 when we talked about takeovers, and we said when a company's stock price gets low, it becomes a takeover target. And so, for example, if this were the situation for a company that I'm running, or maybe I'm looking at a company, and I see that its market to book ratio is less than 1, what that means is theoretically, I could buy all of the stock of this company for $20 per share on the stock market, I could then sell the stock, or essentially sell off all of its assets, pay off all of its debts, and make $23 per share. So I would make, in this case, I would make a $3 profit per share for this particular company just by taking it over. So what this tells us is some companies, especially if they're not managed correctly, some companies are worth more in pieces than they are as a whole company. And it's really simple. You know, I'll give you an example of, let's say I'm driving down the road and I see this old car sitting in a yard, and it's got a for sale sign in the yard. And it is an old piece of crap car. I mean, it's rusted. You can tell it's not worth very much. And it has a $500 price tag on it. So I'm thinking, you know what? I'm going to buy this car. So I buy it, I get it home, and then I pay $500 for it, and then I start pulling it apart and selling off the pieces. So I take the wheels off, I sell them. I take the steering wheel off, I sell it. I take the motor apart, I'll start selling motor parts. I take the seats out, I sell those. And let's say for that car, I eventually sell all the parts for $1,000. Well, that car in pieces was worth $1,000. As a whole car, it was worth $500. So that's just like some companies. Sometimes it's better if you buy a company, you pull it apart, sell off the pieces, and you can make a profit. Now, that's not as popular as it used to be, but there used to be a group of people called corporate raiders, and that's what they did for a living. They would buy companies just like you and I might buy shoes, and they would buy companies. They would either pull them apart and sell them, or they would put their management team in place and let them run the company and make it a more profitable company. So they would do either one of those. So again, market to book ratio. All right. Now, what you see here, and this is in your book actually, this is a couple of different slides here. And this is in your book on page, well, I think it's in your book. It used to be. Okay, it is. Page 88 and 89. These are all of the ratios that we just looked at. So the formulas, and by the way, I forgot to mention, but for the test, I give you a formula sheet, and so it's going to have all of these ratios listed on it. Okay, so you don't have to worry about memorizing ratios, memorizing formulas, any of that. If we cover a formula in class, it will be on that sheet. Okay, now you can see the different ratios. So the categories, you can see the formulas, you can see the a time series. So 2000. This is from another edition of the book, but so this for you would be what? 12, 13, 14, and 15, I believe. Yeah, that's what it's listed as. You've got industry averages. So what you can do is you can do a cross-sectional analysis. So you can compare your company's ratio with an industry average. You can do a time series, so you can tell is the ratio improving or is it getting worse. And then you've got some comments here in terms of, is the ratio good? Is it okay? Is it bad? That type of thing. So if you take a look at all of these numbers and all of these ratios, you'll see that most of these are in pretty good shape. I mean, maybe they go up or down a little bit, but there's not a big difference. The only one that really stands out to me as I go down through here are these two ratios, the average collection period and the average payment period. And if we take a look at these, we can see that the average collection period over the last 3 years is getting longer. Remember, that's how long it takes us to collect money that's owed to us. So we've gone from 41 days to 51 days to almost 60 days. The industry average is 44. So the time series is getting worse, and we are 16 days almost over the industry average. So that's not looking really good. Also, the average payment period, how long it takes us to pay our bills, it's getting longer. It's gone from 75 to 81 to 91 days, and the industry average is 66. And again, that's just not very good. Now, when you're looking at this, And if I were analyzing this company, doing a financial ratio analysis of this company, you've got some things you can do. You can look at this and you go, okay, that's an issue, that's a problem. We need to bring in some highly paid financial consultants to help us get control over our average collection period and our average payment period. That's one choice. But, and keep this in mind when you start managing, well, anything really, is a lot of times the simplest solution is the best place to start. And so if I'm looking at this and I'm looking at for a simple solution, what I might look at is, okay, it's taking us 60 days to collect money that's owed to us. And it's been getting worse. And if we don't have money coming in that's owed to us, then we can't pay the bills that we owe other people. So since our average collection period is getting worse, that might be the cause or one cause of our average payment period getting worse. So what I might do is I might just take a walk down to my collections department, have a heart-to-heart talk with the manager of that department and simply say, hey, what's happening here? This is getting worse. It's been getting worse. Do you not have enough people? Do I need to hire some additional help? Are your people just not working hard enough? What's the deal? We want to get this straightened out. And so one 30-minute conversation might take care of this problem with the average collection period. And then once that cash starts rolling in, we can start paying our bills. And so a 30-minute conversation might solve this entire problem. Now, if that doesn't work, you can always hire your consultants, spend thousands of dollars, and get them to take a look at it. But again, it's just, you've got different options. So that's basically, how you go through ratio analysis. Now, let's see. Okay, one other item here that I want to point out. Now, you don't have to do any calculations here, but you will see this in your book. It's something called the DuPont equation. And what I want you to know are these two items regarding the DuPont equation. One, it merges the income statement and balance sheet into two summary measures of profitability, return on assets and return on equity. And secondly, it proves useful for quick estimates of the impact that operating changes have on returns. For the DuPont equation, that's all you need to know, okay? Just those two statements. And that is basically chapter 3. All right, so now what we will do is on Thursday, I'll see if you have any questions about chapter 3. Also, your quiz will probably open on Thursday, so don't worry about that until then. It'll be open probably Thursday, Friday, and Saturday. We're going to move on to chapter 4, okay? Parts of chapter 4. And then we also, on Thursday, we need to start talking about a possible test date, okay? So, at the earliest, okay, the absolute earliest that you could have your test would be 1 week from Thursday, okay? That's the earliest. And then if you need to, if you decide, hey, that's too soon, we can push it back into the following week, okay? Because typically I set aside 1 day to review for the test. So just be thinking about it. Everybody have a good day. I will see you back here on Thursday to talk about chapter 4.